And it's welcome to Friday night, Your Money, Your Call. I'm Mark Todd from the NAB, and I'm joined by Nick Chaplin, who's also from the NAB, and an old friend, and Mark Bayley from FIIG. Mark and I have had lots of chats over the years about different parts of the credit curve, and I want to get Mark on the show to talk about Brexit. I want to talk about Trump. I want to talk about inflation. We've lots to chat about. We've got some emails already, but feel free to email us. It's 1300 30 34 35. The email is yourmoney@skynews.com.au. And we've got Nick to talk about listed origination and what's happening in the basically in the hybrid market, and some of the ideas that you might have around what's happened to my price. It's all rallied. And so is that a good or bad thing? Is the Trump rally affecting each and every one of you, and therefore what do you do? Do you believe in it? If you're Mexican, do you really believe that's happening? Mark, welcome. FIIG, how are things? What's new?
Yeah, good to be back, Mark. A long time no speak.
You only come on when the football season's not on, so you're a coach on Friday nights and doing all the footy stuff. So
yes,
you're doing the right thing by coming on this early in the year.
Yeah. No, I coach my daughter's rugby team, so it's kind of out of season for me at the moment. But in terms of FIIG, you know, we're going really well at the moment. We've obviously had some management changes, but Jim Stenning's come back in the business. You know, he's a ex-CEO. He's done 14 years there, so. But outside management changes, you know, DCM's done 35 deals in the last 4 years, $1.5 billion raised in unrated. We've got a couple of kind of funds, Gildan Capital is seeing deals all the time in the high to mid teens, you know, putting investors and issuers together. A lot of property deals around at the moment. And then also on the managed income portfolio, the MIPS, that's up to almost 150 million assets under management. For last year, there's several different funds, but last year the Income Plus Fund did, I think it was 4.6 after fees, which is pretty good, kind of a split 50-50 investment grade.
What are we buying in that? Yeah,
it's a rough mix between 50% investment grade, 50% sub-investment grade. Yeah. Duration is reasonably short in that, so it's only 1.75 years. So there's quite a few floaters in there and short-dated corporate bonds as well. So,
what's your role at FIIG now?
Yeah, my role, I'm head of credit strategy and research, and so I'm involved in the new issue process, putting out research on corporate bonds, as well as doing the kind of weekly wire kind of macro topics as well, which I'm sure we'll touch on a few of those today.
Absolutely. Nick, welcome.
Thank you, Mark.
Nervous for you, son going into year 7, just ready?
I'm nervous for him.
Yeah, exactly. You know, when they go into year 7, it's a big deal. They go into that big school and they're all ready to rock and roll. But that hasn't distracted you from the mighty work at the NAB. You've been super busy. You and I were talking about the fact you got only a few days off at the Christmas period, and that's because the pipeline looks pretty strong. There's a lot of corporates talking to you about listed origination. Is that, let's just talk first about your role, but is that also within the context that there wasn't that much in the fourth quarter? There wasn't that, they were all looking at the Trump, they were going, okay, the US election is a reason to probably not do too much because we want to see how it plays out.
Well, it was also interesting that I think what needed to be done in 2016 had been done already, and we're moving into 17 now with a focus now on a different asset class. It's more the rolling, or you know, the refinancing of the tier 2 capital trades, the subordinated debt trades of the major banks now.
So the potential for people to call the bond at the first available opportunity. Do you want to talk to viewers through an idea of a roll, what it actually means?
Yeah, so being subordinated debt, and for banks, they need the approval of APRA to actually call it, but the expectation from investors would be that the anticipation there is that they might call it, and that gives them the need to then put that money back to work again, because if you pull out your money which is earning, in the case of the NAB subordinated debt issue, which comes up in June, 2.75 over the bill rate, that's today it'd be getting you 5.5%. So you've got to think about what you do with that money once it's come out again.
Yeah.
And that's coming up for all of the major banks and some of the regional issuers as well.
So the stuff that FIIG is originating is it's a high yield. So what Nick's talking about is much conservative. It's a conservative piece. So there's this idea that the bond market, you know, don't buy the bond market, it's all bad. Like, the bond market is a one-dimensional thing. And one of the things I'm trying to get everyone to understand in the show is I've got two people from the bond market and they're completely different parts of the bond market.
Yeah, but interestingly, I guess similar to Nick, we're seeing a lot of corporates looking to issue as well. So we've got a pretty hefty pipeline for 2017, of which some will come off and some won't. But there's a big issue of demand because banks are pulling back slightly around the edges in terms of what they're willing to lend. The capital requirements are higher for those unrated corporates that we typically.
So that'll be yours. Will be a high yield space.
Correct. Yeah. So ours is high yield corporate piece, generally speaking. We have done some insurance companies, but it's a high yielding piece. 6, 7, maybe even up to 10%.
Yeah. Right. And obviously the corresponding risk, because the idea that if you're going to borrow at 10%, you are looking to get some juice. So therefore, there's some risks associated with that.
Risk-return spectrum.
And that's fine. That's absolutely understand. You brought some charts in about what's driving the market at the moment. Do you want to walk me through, the idea? And Nick, predominantly a lot of the stuff you did Cube last year, but Mark's making the point. A lot of it is the financial. It's the capital, what the banks need in making the banks much more cautious, much more stable entities.
That's right.
Finding that funding.
Yeah, it's a lot of it is financial, and the investors do want corporate diversity.
Yeah.
It's tricky getting that corporate diversity in a.
So walk me through this chart.
This chart really, I just wanted to show you this because this is 2 years worth of history. So you can see it here from January 15 on the left through to January 17 on the right. You see these are the trading margins. So in other words, if today a major bank was to come out and issue a Tier 1 capital instrument, something that would absorb losses in a really, really bad time, and it would need to be that, where that margin would be. So we're over here on the left at about, where the yellow line starts, at about 3% over the bank bill rate. It got all the way up in terms of trading to about 570 basis points, or 5.7% over the bill rate. At the
so the peak is at the Pearls. Is that 8? Pearls 8.
7.
issues.
Pearls 7 actually. Yeah.
You've written down there Pearls 8. So the peak.
Well, when it was peaking when the Pearls 8 issue came out.
Oh, I see. They came out at 5.2, and that was where the market was trading much higher, and everyone complained about CBA at 5.2, lower than the market price. But of course, they just brought home to everyone the fact that these were very high margins. They
were, and what had been happening to previous transactions up until that point, and the CBA deal really turned the market around. In the end, they got the margin right. But up until that point, there'd been some deals that were offering higher and higher margins. They weren't necessarily performing on listing because the credit spectrum was widening.
Yep.
So they weren't necessarily offering enough for that time. As soon as CBA's come out with Pearls 8, that's turned the market around. There were other aspects to this. There was a supply view in the market that the banks would need to provide a lot more capital.
They'd do equity raise and hybrids,
and it was actually equity, not hybrid Tier 1. That turned the market right around. There was also, the ability for banks to issue.
So for the people who are watching on the show who are now colourblind, rest assured we've got another chart that makes it a bit more simpler.
And it'll be black and white.
So we'll bring that up, and that's more in the black and white genre.
So this one's a little bit simpler. The other one showed a whole bunch of different deals. This is the average of those deals, and you can see how it's traded up to that point in time, which was very early last year in 2016, and over the last year, in we've come. We're now about 30 basis points, with the bottom of the line on the right, above the average, the running average, the long-term average for where these things go. So you could argue there's a little bit more run to go, but it's not. You can see right at the end it started to trade more sideways.
So in terms of capital price, the Pearl 7 obviously issued at par. As the spread widens, that capital price falls. What did it get down to, and where's it trading at now?
Well, Pearl 7 they're all issued at $100. It's now